Question 1. The audit findings indicate that a registered representative is frequently recommending specific securities based on chart patterns and indicators without adequately considering the client's financial situation or investment objectives. Which of the following best describes the appropriate use of technical analysis in making investment recommendations? Option A. Technical analysis, such as identifying a head and shoulders pattern, is a definitive predictor of future price movements, and registered representatives should recommend buying or selling securities solely based on these signals to capitalize on anticipated market shifts. Option B. Technical analysis is primarily a tool for short-term trading and should only be used for clients actively seeking speculative opportunities, regardless of their overall investment strategy or risk tolerance. Option C. Registered representatives can confidently recommend securities based on any technical indicator they are familiar with, as long as they can explain the indicator's basic function, without needing to verify the client's financial circumstances or investment goals. Option D. Technical analysis should be used as a supplementary tool to identify potential trends and patterns, but recommendations must always be grounded in a thorough assessment of the client's suitability profile, including their investment objectives, risk tolerance, and financial situation, with appropriate risk disclosures. The correct answer is D. Technical analysis should be used as a supplementary tool to identify potential trends and patterns, but recommendations must always be grounded in a thorough assessment of the client's suitability profile, including their investment objectives, risk tolerance, and financial situation, with appropriate risk disclosures. Explanation. The audit findings indicate a potential misinterpretation of technical analysis tools, which can lead to inappropriate investment recommendations. This scenario is professionally challenging because it requires the registered representative to not only understand the mechanics of technical analysis, but also to apply it ethically and in compliance with regulatory standards, ensuring that recommendations are suitable for the client and not based on speculative interpretations that could mislead. The correct approach involves using technical analysis as one component of a broader suitability assessment, aligning with FINRA rules that require recommendations to be suitable for the customer's investment profile. This means understanding that technical indicators are not guarantees of future performance, but rather tools to identify potential trends or patterns. Recommendations derived from technical analysis must be presented with appropriate disclosures about the inherent risks and uncertainties, preventing the impression of certainty. This aligns with the ethical obligation to act in the client's best interest and avoid making recommendations based on unfounded predictions. An incorrect approach would be to solely rely on a single technical indicator, such as a moving average crossover, to predict a stock's imminent price surge and recommend aggressive buying without considering the client's risk tolerance, investment objectives, or time horizon. This fails to meet the suitability requirements and could be construed as making a recommendation based on speculative assumptions rather than a comprehensive understanding of the client's needs. Another incorrect approach would be to present technical analysis patterns, like a bullish flag, as definitive signals of guaranteed profit. This misrepresents the nature of technical analysis, which is probabilistic, not deterministic. Such a presentation could mislead clients into believing in a level of certainty that does not exist, violating the duty of fair dealing and potentially leading to unsuitable investment decisions. A third incorrect approach would be to use complex, obscure technical indicators without being able to clearly explain their rationale or limitations to the client. This lack of transparency and understanding can lead to recommendations that are not fully comprehended by the client, undermining the suitability standard and the principle of informed consent. Professionals should approach technical analysis by first understanding the client's financial situation, investment objectives, and risk tolerance. Technical analysis should then be used as a tool to identify potential opportunities or risks within the context of these client-specific factors. Any recommendations derived from technical analysis must be accompanied by clear explanations of the methodology, its limitations, and the associated risks, ensuring that the client can make an informed decision. This process emphasizes suitability, transparency, and ethical conduct, which are paramount in the securities industry. Question 2. The control framework reveals that a client is considering an investment in a company that offers both common stock and preferred stock. The client is primarily seeking a stable income stream with a degree of capital preservation. As a financial advisor, how should you best explain the fundamental differences in dividend rights and priority between these two classes of stock to ensure the client makes an informed decision? Option A. Emphasize that preferred stock guarantees a fixed dividend payment that is prioritized over any dividends paid to common stockholders, and explain that this priority also applies to asset distribution in case of liquidation, while also noting the typically limited potential for capital appreciation compared to common stock. Option B. Focus on the potential for significant capital gains with preferred stock, similar to common stock, and mention that dividend payments are discretionary for both classes of stock, depending on the company's profitability. Option C. Advise the client that preferred stock is a safer investment than common stock because it is less volatile and has a guaranteed dividend, comparable to a bond, with no significant differences in priority during liquidation. Option D. Highlight that preferred stock often offers a higher dividend yield than common stock, making it a more attractive option for income generation, and suggest that both types of stock provide similar levels of voting rights. The correct answer is A. Emphasize that preferred stock guarantees a fixed dividend payment that is prioritized over any dividends paid to common stockholders, and explain that this priority also applies to asset distribution in case of liquidation, while also noting the typically limited potential for capital appreciation compared to common stock. Explanation. The control framework reveals a scenario where a financial advisor must navigate the differing rights and expectations associated with various classes of stock. This situation is professionally challenging because it requires a deep understanding of the inherent characteristics of fixed dividends and the preferential treatment of preferred stock over common stock, not just in terms of potential returns, but also in the context of corporate actions and financial distress. The advisor must ensure that their recommendations align with the client's investment objectives, while strictly adhering to regulatory guidelines that govern fair dealing and disclosure. Misinterpreting or misrepresenting these differences can lead to significant client dissatisfaction, regulatory scrutiny, and potential legal repercussions. The correct approach involves clearly explaining to the client that preferred stock typically offers a fixed dividend payment, which is paid before any dividends are distributed to common stockholders. This preferential treatment extends to the distribution of assets in the event of liquidation. The advisor must emphasize that while this offers a degree of stability and predictability, it often comes with limited potential for capital appreciation compared to common stock. This approach is ethically sound and regulatorily compliant because it prioritizes full and fair disclosure, ensuring the client makes an informed decision based on accurate information about the rights and characteristics of each security. This aligns with the principles of suitability and client best interest mandated by securities regulations. An incorrect approach would be to focus solely on the potential for higher dividend yields on preferred stock, without adequately explaining the limitations on capital growth or the implications of the fixed dividend in a rising interest rate environment. This failure to provide a balanced perspective misrepresents the overall investment profile and can lead to client disappointment if market conditions or the company's performance do not favor fixed income-like securities. Another incorrect approach would be to suggest that preferred stockholders have voting rights equivalent to common stockholders. This is a fundamental misunderstanding of the typical structure of preferred stock, which generally does not carry voting rights unless specific conditions are met, such as missed dividend payments. Failing to clarify this distinction can mislead clients about their influence and control within the company. A third incorrect approach would be to imply that preferred stock offers the same level of risk as government bonds. While preferred stock has some income-like characteristics, it is still an equity instrument and carries significantly more risk than government-backed debt, particularly regarding the possibility of dividend suspension or the company's financial health impacting the stock's value. Professionals should approach such situations by first identifying the core characteristics of the securities in question, specifically focusing on dividend rights, liquidation preferences, and voting rights. They should then consider the client's individual financial goals, risk tolerance, and time horizon. The next step is to communicate these characteristics clearly and comprehensively to the client, using plain language and avoiding jargon. This communication should highlight both the advantages and disadvantages of each security type relative to the client's objectives. Finally, professionals must ensure their recommendations are suitable and documented, demonstrating that the client's best interests were paramount throughout the advisory process. Question 3. Strategic planning requires a financial advisor to accurately communicate the implications of bond ratings to a client. Which of the following best reflects the regulatory expectation regarding the discussion of bond ratings? Option A. Bond ratings are opinions on the issuer's creditworthiness and indicate the level of credit risk, but they do not guarantee against loss or predict future market performance. Option B. A high bond rating signifies that the investment is risk-free and will always increase in value. Option C. A low bond rating indicates that the bond is a good opportunity for aggressive growth and should be recommended to all clients seeking high returns. Option D. Bond ratings are irrelevant to investment suitability as they only reflect historical default data. The correct answer is A. Bond ratings are opinions on the issuer's creditworthiness and indicate the level of credit risk, but they do not guarantee against loss or predict future market performance. Explanation. This scenario is professionally challenging because it requires a financial professional to interpret and apply bond rating information in a way that aligns with regulatory expectations for client suitability and risk disclosure, without misrepresenting the nature of credit risk. The core challenge lies in distinguishing between a bond rating as an indicator of creditworthiness and its potential misinterpretation as a guarantee of investment performance or a complete absence of risk. The correct approach involves understanding that bond ratings, such as those provided by Moody's, S&P, or Fitch, are opinions on the likelihood of a bond issuer defaulting on its debt obligations. These ratings are a crucial tool for assessing credit risk, but they are not absolute guarantees. Regulatory frameworks, such as those overseen by FINRA in the U.S., emphasize that registered representatives must have a reasonable basis for believing that a recommended investment is suitable for a particular customer. This includes understanding the risks associated with the investment, such as credit risk, interest rate risk, and liquidity risk. Therefore, when discussing bond ratings, a professional must accurately convey that a higher rating signifies lower credit risk, while a lower rating signifies higher credit risk, and that even highly rated bonds carry some level of risk. This aligns with the regulatory obligation to provide accurate and fair information to clients and to avoid making misleading statements. An incorrect approach would be to present a high bond rating as a definitive indicator of safety or a guarantee against loss. This misrepresents the nature of credit risk and the limitations of bond ratings. Regulators expect professionals to educate clients about the inherent risks in all investments, including bonds. Another incorrect approach would be to ignore bond ratings altogether when discussing investment suitability. While ratings are not the sole determinant of suitability, they are a primary indicator of creditworthiness and a key component of risk assessment that cannot be disregarded. Failing to consider and discuss relevant risk factors, including credit ratings, would be a violation of the duty to recommend suitable investments. Finally, an incorrect approach would be to overemphasize the potential for capital appreciation based solely on a bond's rating, as bond ratings primarily address credit risk, not necessarily market price fluctuations, driven by other factors like interest rate changes. A professional reasoning process for similar situations should involve a thorough understanding of the investment product, its associated risks, and the client's financial situation, objectives, and risk tolerance. Professionals must always prioritize accurate and transparent communication, ensuring that clients understand the potential risks and rewards of any investment. This involves staying current with regulatory guidance on disclosure and suitability, and always acting in the client's best interest. Question 4. The assessment process reveals that a registered representative has overheard a conversation between two senior executives of a publicly traded company discussing a significant, undisclosed product development that is expected to substantially increase the company's future earnings. The representative recognizes this information as material and non-public. What is the most appropriate ethical and regulatory course of action for the registered representative? Option A. Purchase shares of the company's stock for their personal account, believing the information will lead to a profitable trade before the market reacts. Option B. Share the overheard information with a close friend who is also an investor, suggesting they consider buying the stock. Option C. Disregard the overheard conversation as it was not directly communicated to them and proceed with their planned personal trades in other securities. Option D. Immediately report the information to the firm's compliance department and refrain from any personal trading in the company's stock until the information is publicly disclosed. The correct answer is D. Immediately report the information to the firm's compliance department and refrain from any personal trading in the company's stock until the information is publicly disclosed. Explanation. This scenario presents a professional challenge because it requires an individual to balance their personal financial interests with their duty to act in the best interest of their clients and adhere to regulatory standards. The temptation to leverage non-public information for personal gain, even if seemingly minor, creates an ethical conflict and potential legal ramifications. Careful judgment is required to ensure all actions are compliant with securities regulations and ethical codes of conduct. The correct approach involves immediately reporting the potential insider information to the appropriate compliance department or supervisor and refraining from any personal trading activity based on that information until it is publicly disclosed or deemed immaterial. This aligns with the fundamental regulatory principle of fair dealing and the prohibition against insider trading, as established by the Securities Exchange Act of 1934 and FINRA rules. Acting with integrity and transparency by disclosing the information and abstaining from trading demonstrates a commitment to client protection and market integrity, which are paramount in the securities industry. An incorrect approach of trading on the information before it is public would constitute insider trading, a serious violation of securities laws. This action breaches the duty of trust owed to the company whose stock is involved and to the investing public, undermining market fairness. Another incorrect approach of discussing the information with friends or family who might then trade on it would be considered tipping, which is also illegal and carries severe penalties, as it facilitates insider trading by others. Finally, ignoring the information and proceeding with personal trades, as if nothing was learned, would be a failure to exercise due diligence and a disregard for potential regulatory breaches, exposing both the individual and potentially their firm to significant legal and reputational damage. Professionals should employ a decision-making framework that prioritizes compliance and ethical conduct. This involves recognizing potential conflicts of interest or material non-public information, immediately consulting internal compliance policies and procedures, and seeking guidance from supervisors or compliance officers. When in doubt, the safest and most ethical course of action is always to err on the side of caution, which typically means abstaining from any action that could be perceived as a violation until clarity is obtained from the appropriate authorities. Question 5. Cost-benefit analysis shows that expediting the due diligence process for promising technology companies' initial public offering, IPO, could significantly increase the underwriting firm's fees. However, this expedited process might mean less time to independently verify certain forward-looking statements made by the issuer's management, which approach best aligns with the regulatory framework governing IPOs. Option A. Conduct a comprehensive and independent due diligence process, even if it delays the offering and potentially reduces immediate fees, to ensure the accuracy of all disclosures and protect investors. Option B. Allocate a larger portion of the offering to institutional investors who are presumed to be sophisticated enough to assess the risks themselves, thereby reducing the firm's direct responsibility for verifying all disclosures. Option C. Proceed with the expedited due diligence, relying primarily on the issuer's representations to capture the lucrative underwriting fees and bring the innovative company to market quickly. Option D. Negotiate with the issuer to remove the most speculative forward-looking statements from the registration statement to reduce the due diligence burden and speed up the process. The correct answer is C. Proceed with the expedited due diligence, relying primarily on the issuer's representations to capture the lucrative underwriting fees and bring the innovative company to market quickly. Explanation. This scenario is professionally challenging because it requires a firm to balance the potential financial benefits of underwriting an initial public offering IPO with its regulatory obligations to ensure fair and orderly markets and protect investors. The pressure to secure a lucrative underwriting deal can create a conflict of interest, making it crucial for the firm to adhere strictly to regulatory guidelines. Careful judgment is required to navigate the complexities of the IPO process, including due diligence, pricing, and distribution, while upholding ethical standards. The correct approach involves a thorough and independent due diligence process that verifies the accuracy and completeness of the information presented in the registration statement. This includes scrutinizing the issuer's financial health, business operations, management team, and any potential risks. The firm must also ensure that the offering price is reasonably determined and that the securities are distributed fairly to investors, avoiding manipulative practices. This approach is justified by the Securities Act of 1933 and the Securities Exchange Act of 1934, which mandate full disclosure and prohibit fraud and manipulation in the offering and trading of securities. FINRA rules, such as Rule 5130 regarding the allocation of IPOs, also play a critical role in ensuring fairness. An incorrect approach that prioritizes speed and profitability over thoroughness would fail to meet the due diligence requirements. This could lead to the dissemination of misleading information to investors, violating the anti-fraud provisions of the securities laws. Another incorrect approach that involves allocating a disproportionate number of shares to favored clients or firm insiders, without regard for fair distribution, would violate FINRA Rule 5130 and undermine market integrity. A third incorrect approach that involves engaging in spinning by conditioning the underwriting on the purchase of other services from the firm would create an unacceptable conflict of interest and potentially violate rules against market manipulation and unfair practices. Professionals should employ a decision-making framework that begins with identifying all relevant regulatory requirements and ethical considerations. They should then gather all necessary information, conduct thorough due diligence, and consult with legal and compliance departments. The decision should be based on whether the proposed actions align with regulatory mandates and uphold the principles of fairness, transparency, and investor protection. If any doubt exists, the firm should err on the side of caution and seek further clarification or guidance. Question 6. Quality control measures reveal that a registered representative is explaining different types of preferred stock to a client. The representative states that if a company misses a dividend payment on cumulative preferred stock, the client will never receive that missed payment. Which of the following statements best describes the error in the representative's explanation regarding the characteristics of cumulative preferred stock? Option A. Convertible preferred stock gives the holder the option to exchange their preferred shares for common shares. Option B. Non-cumulative preferred stock means that missed dividend payments are permanently lost to the shareholder. Option C. Callable preferred stock allows the issuer to redeem the shares at a specified price, which is unrelated to dividend payment obligations. Option D. Cumulative preferred stock requires that any missed dividend payments must be paid to shareholders before any dividends can be paid to common stockholders. The correct answer is D. Cumulative preferred stock requires that any missed dividend payments must be paid to shareholders before any dividends can be paid to common stockholders. Explanation. This scenario presents a professional challenge because it requires a clear understanding of different preferred stock features and their implications for investors, particularly in the context of potential future events. A financial advisor must accurately explain these features to a client to ensure informed decision-making, avoiding misrepresentation or omission of critical details. The challenge lies in distinguishing between the rights and protections offered by each type of preferred stock, especially when considering scenarios like dividend payments and potential redemption. The correct approach involves accurately identifying and explaining the characteristics of cumulative preferred stock. This type of preferred stock ensures that any missed dividend payments must be paid to shareholders before common stockholders can receive any dividends. This protection is crucial for investors seeking a more predictable income stream and a higher degree of security compared to non-cumulative preferred stock. Regulatory frameworks, such as those overseen by FINRA for the U.S. securities industry, emphasize the importance of fair dealing and providing accurate information to customers. Explaining cumulative preferred stock correctly aligns with the duty to provide suitable recommendations and to ensure clients understand the products they are investing in, preventing potential disputes and ensuring client satisfaction. An incorrect approach would be to confuse cumulative preferred stock with non-cumulative preferred stock. Non-cumulative preferred stock does not require the issuer to pay missed dividends in the future. If a dividend is missed, that payment is permanently lost to the shareholder. This misrepresentation would violate the principle of fair dealing and could lead to a client making an investment decision based on incomplete or inaccurate information, potentially resulting in financial harm and regulatory sanctions for the advisor. Another incorrect approach would be to equate cumulative preferred stock with callable preferred stock without proper qualification. Callable preferred stock gives the issuer the right to repurchase the shares at a specified price after a certain date. While a company might call preferred stock when it has the financial capacity to do so, this feature is distinct from the dividend payment rights associated with cumulative preferred stock. Misrepresenting this would fail to inform the client about the potential for their investment to be redeemed, which could impact their long-term investment strategy and income expectations. Finally, incorrectly associating cumulative preferred stock with convertible preferred stock would also be a failure. Convertible preferred stock gives the holder the option to convert their preferred shares into a specified number of common shares. This feature offers potential upside participation in the company's growth, which is separate from the dividend payment guarantees of cumulative preferred stock. Failing to distinguish these features would mislead the client about the nature of their investment and the potential benefits and risks involved. The professional decision-making process for similar situations should involve a thorough review of the specific features of any security being discussed. This includes understanding the definitions and implications of terms like cumulative, non-cumulative, callable, and convertible. When advising clients, it is imperative to use precise language, clearly articulate the rights and obligations associated with each feature, and ensure the client comprehends these distinctions. If there is any doubt about the client's understanding, further clarification or educational materials should be provided. Adherence to regulatory guidelines regarding fair dealing, suitability, and accurate disclosure is paramount. Question 7. Governance review demonstrates that a broker-dealer firm, after successfully underwriting an initial public offering, IPO, of a technology company's stock, has implemented a strategy where its trading desk actively purchases shares in the secondary market during the first month of trading. These purchases are intended to absorb selling pressure and maintain the stock's price at or slightly above the IPO offering price, while simultaneously the firm's research department publishes a positive, but not overly promotional, report on the company's long-term prospects. The firm is also engaging in standard market-making activities for the stock. Which of the following best describes the firm's adherence to regulatory requirements concerning market structure? Option A. The firm is engaging in prohibited market manipulation by artificially supporting the stock price in the secondary market to protect the success of the primary offering. Option B. The firm is violating prospectus delivery rules by failing to ensure that all secondary market purchasers receive a copy of the original prospectus. Option C. The firm is improperly using proprietary information from the underwriting process to influence its secondary market trading activities. Option D. The firm is appropriately distinguishing between its roles in the primary and secondary markets by facilitating the initial distribution and then providing liquidity and research support in the subsequent trading environment. Correct answer is D. The firm is appropriately distinguishing between its roles in the primary and secondary markets by facilitating the initial distribution and then providing liquidity and research support in the subsequent trading environment. Explanation. This scenario is professionally challenging because it requires a firm to distinguish between the fundamental roles of the primary and secondary markets and to understand how a firm's actions can impact the integrity of both. The firm must navigate the regulatory landscape, governing how securities are initially offered and subsequently traded, ensuring compliance with rules designed to protect investors and maintain fair markets. Careful judgment is required to avoid actions that could be construed as market manipulation or a misrepresentation of a securities offering. The correct approach involves recognizing that the firm's role in the primary market is to facilitate the initial distribution of securities to investors, adhering to prospectus requirements and fair pricing. In the secondary market, the firm's role shifts to providing liquidity and facilitating trading among investors, operating under rules that prevent artificial price inflation or manipulation. By engaging in the described activities, the firm is correctly distinguishing between these two distinct market functions and acting appropriately within the regulatory framework for each. This aligns with the Securities Act of 1933 and the Securities Exchange Act of 1934, which delineate the regulations for primary and secondary market activities, respectively, ensuring investor protection and market integrity. An incorrect approach would be to treat the initial offering price as a benchmark for subsequent trading in a way that artificially supports the price, blurring the lines between primary distribution and secondary market trading. This could involve the firm's trading desk actively buying shares in the secondary market solely to maintain the offering price, rather than reflecting genuine investor demand. Such actions could violate rules against market manipulation, as they create a false impression of market activity and price stability. This would be a failure to adhere to the principles of fair and orderly markets as mandated by the Securities Exchange Act of 1934. Another incorrect approach would be to use information obtained during the primary offering process to unfairly influence trading decisions in the secondary market, or vice versa. For example, if the firm had non-public information about the issuer's performance that emerged after the IPO, using this to guide its secondary market trading without proper disclosure would be a violation. This would contravene insider trading regulations and the duty of fair dealing owed to all market participants. The professional reasoning process for such situations involves a thorough understanding of the Securities Act of 1933 and the Securities Exchange Act of 1934. Professionals must first identify the specific market in which an activity is occurring, primary or secondary. Then, they must assess whether their actions are consistent with the regulatory objectives and prohibitions applicable to that market. This includes understanding rules related to prospectus delivery, anti-manipulation, fair pricing, and disclosure. When in doubt, seeking guidance from compliance departments or legal counsel is crucial to ensure adherence to the complex regulatory framework governing securities markets. Question 8. Stakeholder feedback indicates that some new underwriting teams are prioritizing the speed of closing deals over the thoroughness of their due diligence investigations for initial public offerings, IPO. Which of the following approaches best aligns with the regulatory framework and ethical obligations for underwriters in the United States? Option A. Relying primarily on the issuer's management team to provide accurate and complete information, with minimal independent verification, to expedite the offering process. Option B. Conducting a comprehensive review of the issuer's business, financial condition, and legal compliance, including independent verification of material information, to ensure all potential risks are identified and disclosed. Option C. Prioritizing cost-effectiveness and speed of execution in due diligence, even if it means accepting a higher level of residual risk for investors. Option D. Focusing solely on the issuer's historical financial performance and projections, while giving less weight to operational, legal, and market risk assessments. Correct answer is B. Conducting a comprehensive review of the issuer's business, financial condition, and legal compliance, including independent verification of material information, to ensure all potential risks are identified and disclosed. Explanation. This scenario is professionally challenging because it requires an underwriter to balance the issuer's desire for a swift and favorable offering with the fundamental regulatory obligation to conduct thorough due diligence. The pressure to close a deal quickly can tempt an underwriter to cut corners, potentially exposing investors to undisclosed risks. The core of the challenge lies in the underwriter's fiduciary responsibility to the investing public, which is paramount and supersedes the issuer's immediate interests. The correct approach involves a comprehensive review of all material information, including financial statements, business operations, legal compliance, and any potential risks. This rigorous process is mandated by regulations such as the Securities Act of 1933 and the Securities Exchange Act of 1934, which hold underwriters liable for misstatements or omissions in registration statements and prospectuses. The reasonable investigation standard, as interpreted by case law and regulatory guidance, requires underwriters to go beyond simply accepting the issuer's representations and to actively seek out and verify information. This diligence is not merely a best practice, but a legal requirement to ensure that investors have access to accurate and complete information for making informed investment decisions. An incorrect approach that relies solely on the issuer's representations without independent verification fails to meet the reasonable investigation standard. This constitutes a significant regulatory failure, as it bypasses the underwriter's duty to uncover and disclose material risks. Ethically, it is a breach of trust with potential investors. Another incorrect approach that focuses only on the financial aspects of the issuer, neglecting operational, legal, and market risks, is also deficient. Due diligence must be holistic. Regulatory frameworks require consideration of all factors that could materially impact an investment's value. Ignoring non-financial risks, even if the financials appear sound, can lead to investor losses and regulatory sanctions. An approach that prioritizes speed and cost efficiency over the depth of due diligence is fundamentally flawed. While efficiency is desirable, it cannot come at the expense of regulatory compliance and investor protection. The Securities and Exchange Commission, SEC, and FINRA emphasize the importance of robust due diligence, and any shortcuts taken to expedite the process can result in severe penalties, including fines, disgorgement of profits, and reputational damage. The professional decision-making process for similar situations should involve a structured risk assessment framework. This begins with identifying all potential areas of inquiry relevant to the offering. Next, the underwriter must determine the appropriate level of investigation for each area, considering the issuer's industry, size, and complexity. Crucially, the underwriter must maintain independence from the issuer's management and be prepared to challenge assumptions and seek corroborating evidence. If material issues are identified, the underwriter must ensure they are adequately disclosed or addressed before proceeding with the offering. This systematic and diligent approach is essential for fulfilling both regulatory obligations and ethical responsibilities. Question 9. Quality control measures reveal that a financial advisor is preparing to discuss investment options with a new client who is interested in mutual funds. The advisor has identified two funds with similar investment objectives and historical performance, but with differing fee structures. One fund has a higher management fee but no 12b1 fees, while the other has a lower management fee but includes a 12b1 fee. The advisor needs to explain these differences to the client. Which approach best demonstrates adherence to regulatory requirements and ethical best practices for client communication regarding fund expenses? Option A. Explain that the expense ratio is the most important factor to consider and that the difference in individual fees is negligible. Option B. Focus solely on the lower management fee of the second fund, highlighting it as a cost-saving measure for the client. Option C. State that fund expenses are complex and that the client should not be overly concerned with the specific fee breakdowns as long as the fund performs well. Option D. Detail the purpose of management fees, compensation for investment management, and 12b1 fees, marketing and distribution costs, and explain how these contribute to the overall expense ratio, emphasizing the importance of understanding the total cost of investing. The correct answer is A. Explain that the expense ratio is the most important factor to consider and that the difference in individual fees is negligible. Explanation. This scenario is professionally challenging because it requires a financial advisor to interpret and communicate complex fund expense information accurately to a client, balancing the need for transparency with the client's understanding. The advisor must ensure the client comprehends the impact of various fees on their investment returns, which is crucial for informed decision-making. The challenge lies in translating technical terms like management fees, 12b1 fees, and expense ratios into practical implications for the client's portfolio. The correct approach involves clearly explaining each component of fund expenses and their cumulative effect, as represented by the expense ratio. This approach is right because it prioritizes client education and transparency, aligning with the regulatory obligation to act in the client's best interest. Specifically, FINRA rules, which govern the Series 110 exam, emphasize the importance of providing clear and accurate information about investment products, including their associated costs. Explaining that management fees compensate the fund manager, 12b1 fees cover marketing and distribution, and the expense ratio is the total annual operating cost as a percentage of assets, empowers the client to understand the true cost of their investment. This directly supports the principle of suitability and fiduciary duty, ensuring the client can make an informed decision based on a complete understanding of the financial implications. An incorrect approach would be to solely focus on the expense ratio without detailing its components. This fails to provide the client with a granular understanding of where their money is going and why certain fees are charged. It could lead to confusion about the different types of costs and their purposes, potentially obscuring the advisor's own compensation structure if 12b1 fees are involved. This approach risks violating disclosure requirements by not providing sufficient detail. Another incorrect approach would be to downplay the significance of fund expenses, suggesting they are a minor factor in investment performance. This is ethically problematic and potentially misleading. All fund expenses directly reduce investment returns, and their cumulative impact over time can be substantial. Minimizing their importance undermines the client's ability to make a fully informed decision and could be seen as a failure to disclose material information, violating FINRA rules on fair dealing and misleading communications. A third incorrect approach would be to only discuss management fees and ignore 12b1 fees and the overall expense ratio. This provides an incomplete picture of the fund's costs. 12b1 fees, in particular, are often a point of scrutiny as they can be used for distribution and marketing, which may not directly benefit all investors equally. Omitting these or the total expense ratio fails to provide a comprehensive understanding of the investment's cost structure, thereby failing to meet the standard of full and fair disclosure required by securities regulations. Professional decision-making in such situations requires a commitment to client-centric communication. Advisors should always aim to simplify complex financial concepts without sacrificing accuracy. This involves anticipating client questions, proactively providing relevant information, and ensuring that all disclosures are clear, concise, and easily understandable. The advisor must consider the client's financial literacy and tailor their explanations accordingly, always adhering to the spirit and letter of regulatory requirements regarding disclosure and fair dealing. Question 10. The risk matrix shows a potential for increased trading activity in municipal bonds. A registered representative is advising a client on the purchase of these securities and is seeking guidance on the most relevant regulatory framework for disclosure and fair dealing practices. Which regulatory body's rules are most directly applicable to the disclosure and fair dealing standards for municipal securities? Option A, the Securities and Exchange Commission (SEC). Option B, the Municipal Securities Rulemaking Board (MSRB). Option C, State Securities Regulators. Option D, the Financial Industry Regulatory Authority (FINRA). The correct answer is B, the Municipal Securities Rulemaking Board (MSRB). Explanation: this scenario is professionally challenging because it requires a nuanced understanding of the distinct roles and jurisdictions of various U.S. regulatory bodies in overseeing securities markets and protecting investors. A financial advisor must correctly identify which regulator has primary authority over a specific type of security and the associated disclosure requirements to ensure compliance and provide accurate guidance to clients. The correct approach involves recognizing that municipal securities, such as those issued by state and local governments, fall under the purview of the Municipal Securities Rulemaking Board (MSRB) for rulemaking and the Securities and Exchange Commission (SEC) for enforcement. The MSRB establishes rules for the underwriting, trading, and disclosure of municipal securities, while the SEC has broad oversight of the securities markets. Therefore, understanding MSRB rules is critical for any firm dealing with municipal securities. An incorrect approach would be to assume that all securities are regulated solely by the SEC. While the SEC has overarching authority, it delegates specific rulemaking authority in certain areas. Misattributing regulatory oversight to the SEC for municipal securities without acknowledging the MSRB's specific role demonstrates a lack of comprehensive knowledge and could lead to non-compliance with MSRB rules. Another incorrect approach is to believe that FINRA is the primary regulator for municipal securities. FINRA, Financial Industry Regulatory Authority, is a self-regulatory organization, SRO, that oversees broker-dealers in the United States. While FINRA members are subject to MSRB rules, FINRA itself does not set the rules for municipal securities. The MSRB does. Confusing FINRA role with the MSRB rulemaking authority is a significant error. Finally, assuming that state regulators are the primary authority for municipal securities is also incorrect. While state securities regulators, often referred to as blue sky regulators, have jurisdiction over securities sold within their states, the MSRB rules govern the municipal securities market nationally, and the SEC has federal oversight. Relying solely on state regulators for guidance on municipal securities would overlook the federal and MSRB-specific regulatory framework. Professionals should employ a decision-making framework that begins with identifying the specific type of security or transaction in question. Once identified, they must then determine the primary regulatory body or bodies responsible for that specific area, considering the distinct roles of the SEC, FINRA, MSRB, and state regulators. This involves consulting relevant regulations and guidelines for each body to ensure accurate understanding and compliance. Question 11. Market research demonstrates that investors are seeking a range of corporate bond options to diversify their portfolios. A financial advisor is discussing three types of corporate bonds with a client: secured bonds, unsecured bonds, and convertible bonds. The advisor needs to explain the fundamental differences in risk and potential return among these options to help the client make an informed decision. Which of the following best describes the primary distinction in risk and return profiles for these bond types, relevant to an investor's decision-making process under the Series 110 exam framework? Option A. Convertible bonds are the least risky because they can be converted into stock. Secured bonds offer moderate risk and moderate return, and unsecured bonds are the riskiest with the highest potential return. Option B. Secured bonds offer the highest potential return because they are backed by assets. Unsecured bonds have moderate risk and return, and convertible bonds are the safest due to their fixed income nature. Option C. Unsecured bonds are the safest option because they are issued by established corporations. Secured bonds offer the highest potential return due to their flexibility, and convertible bonds are primarily for short-term speculation. Option D. Secured bonds generally carry lower risk and lower potential return due to collateral backing. Unsecured bonds carry higher risk and higher potential return due to reliance on creditworthiness. And convertible bonds offer potential equity upside, but with added complexity and conversion-specific risks. Correct answer is D. Secured bonds generally carry lower risk and lower potential return due to collateral backing. Unsecured bonds carry higher risk and higher potential return due to reliance on creditworthiness. And convertible bonds offer potential equity upside, but with added complexity and conversion-specific risks. Explanation. This scenario is professionally challenging because it requires a financial professional to accurately assess the risk and return profile of different corporate bond types for a client, ensuring the recommendation aligns with the client's investment objectives and risk tolerance, while strictly adhering to the regulatory framework governing the Series 110 exam. The challenge lies in distinguishing the inherent characteristics of secured, unsecured, and convertible bonds, and their implications for investor protection and suitability. The correct approach involves understanding that secured bonds are backed by specific collateral, offering a higher degree of safety and typically lower yields compared to unsecured bonds. Unsecured bonds, or debentures, rely on the issuer's general creditworthiness, making them riskier and thus usually offering higher yields. Convertible bonds provide the holder the option to convert into equity, introducing an element of potential capital appreciation, but also complexity and different risk factors. A professional must evaluate these differences in the context of a client's stated goals, such as capital preservation versus growth, and their capacity to absorb potential losses. The regulatory framework for the Series 110 exam emphasizes investor protection and suitability, meaning recommendations must be based on a thorough understanding of the products and the client's profile. An incorrect approach would be to recommend a secured bond solely because it is perceived as the safest, without considering if its lower yield meets the client's growth objectives. This fails to address the client's needs comprehensively and could lead to underperformance relative to their goals. Another incorrect approach would be to recommend an unsecured bond without adequately explaining the increased credit risk to the client, potentially exposing them to greater loss than they are comfortable with. Recommending a convertible bond without ensuring the client understands the equity-like risks and potential for dilution or conversion timing issues would also be a failure in disclosure and suitability. Professional decision-making in such situations requires a systematic process. First, thoroughly understand the client's investment objectives, risk tolerance, and financial situation. Second, possess a deep knowledge of the characteristics, risks, and potential rewards of each investment product being considered, including secured, unsecured, and convertible bonds. Third, match the product's attributes to the client's profile and objectives, providing clear and transparent explanations of all associated risks and benefits. Finally, document the recommendation and the rationale behind it, ensuring compliance with all applicable regulations. Question 12. Process analysis reveals that a financial analyst is tasked with valuing two distinct publicly traded companies. Company Alpha, a mature, established firm that consistently pays a significant portion of its earnings as dividends, and Company Beta, a rapidly growing technology startup that reinvests all its profits back into research and development and therefore pays no dividends. The analyst is considering using either the dividend discount model, DDM, or the price-to-earnings, P/E ratio for their valuation. Which of the following approaches represents the most appropriate and professionally sound method for valuing these companies, considering the principles of effective investment analysis? Option A. Apply the price-to-earnings ratio to company alpha and the dividend discount model to company beta. Option B. Apply the price-to-earnings ratio to both company alpha and company beta. Option C. Apply the dividend discount model to both company alpha and company beta. Option D. Apply the dividend discount model to company alpha and the price-to-earnings ratio to company beta. The correct answer is C. Apply the dividend discount model to both company alpha and company beta. Explanation: this scenario is professionally challenging because it requires a financial analyst to select the most appropriate valuation method for a specific investment scenario, considering the limitations and strengths of each method within the context of the Securities Industry Essentials Examination's regulatory framework. The analyst must demonstrate an understanding of how different valuation models align with the characteristics of the underlying asset and the information available, adhering to principles of sound investment analysis and disclosure. The correct approach involves using the dividend discount model, DDM, when valuing a mature dividend-paying company. This method is appropriate because it directly links the intrinsic value of a stock to the present value of its expected future dividends. This aligns with the regulatory expectation that investment recommendations should be based on a thorough analysis of the security's fundamentals. The DDM is particularly suitable for stable companies where dividend payouts are predictable, providing a more direct measure of shareholder return than methods that rely on earnings which can be subject to accounting manipulations or cyclical fluctuations. An incorrect approach would be to solely rely on the price-to-earnings, P/E ratio, when valuing a company that does not pay dividends or has highly volatile earnings. While the P/E ratio is a common valuation metric, its effectiveness is diminished in such situations. Ethically, recommending an investment based on a metric that is not well suited to the company's financial profile could be misleading to clients. From a regulatory perspective, this could be seen as a failure to conduct adequate due diligence, potentially violating rules that require recommendations to be suitable and based on sound analysis. Another incorrect approach would be to apply the dividend discount model to a growth company that reinvests all its earnings and pays no dividends. In this case, the DDM would yield an inaccurate or zero valuation, as there are no dividends to discount. This would be a failure to understand the model's assumptions and limitations, leading to a flawed valuation. Regulatory bodies expect professionals to select valuation methods that are appropriate for the specific characteristics of the security being analyzed. A further incorrect approach would be to use the P/E ratio as the sole determinant of value for a company in a highly cyclical industry, without considering the cyclical nature of its earnings. This could lead to an overvaluation during peak earnings periods and an undervaluation during troughs, failing to provide a stable and reliable valuation. This demonstrates a lack of nuanced analysis, which is a cornerstone of professional conduct and regulatory compliance. The professional decision-making process for similar situations should involve 1. Understanding the characteristics of the company being valued, e.g., dividend policy, growth stage, industry cyclicality. 2. Identifying the available information and its reliability. 3. Selecting valuation models whose assumptions and inputs are consistent with the company's characteristics and available data. 4. Critically evaluating the results of the chosen model, and considering their limitations. 5. Ensuring that the valuation analysis supports a sound and justifiable investment recommendation, in line with regulatory requirements for suitability and due diligence. Question 13. Risk assessment procedures indicate that a new associate needs a clear understanding of the primary role of a broker-dealer within the securities industry. Which of the following best describes this primary role? Option A. To engage exclusively in proprietary trading, buying and selling securities for the firm's own account. Option B. To provide personalized investment recommendations and financial planning services to clients. Option C. To act as an intermediary, facilitating the buying and selling of securities for customers. Option D. To underwrite and distribute all newly issued securities to the public. The correct answer is C. To act as an intermediary, facilitating the buying and selling of securities for customers. Explanation. This scenario is professionally challenging because it requires a financial professional to navigate the fundamental principles of the securities industry while adhering strictly to the regulatory framework of the Securities Industry Essentials Examination, (SI). The SIE exam focuses on foundational knowledge, and understanding the core functions and participants of the securities industry is paramount. The challenge lies in identifying the approach that best reflects the established regulatory understanding of how the industry operates and the roles within it, without introducing extraneous concepts or misinterpretations. The correct approach involves accurately identifying the primary function of a broker-dealer as an intermediary, facilitating the buying and selling of securities on behalf of customers. This aligns directly with the regulatory definitions and expectations for such firms under the Securities Exchange Act of 1934 and related FINRA rules, which are foundational to the SIE exam. Broker-dealers are regulated entities whose core business is to connect buyers and sellers in the securities markets, thereby providing liquidity and market access. An incorrect approach that focuses solely on investment advice, without the intermediary function, fails to capture the full scope of a broker-dealer's role as defined by regulations. While some broker-dealers may offer advisory services, their primary regulatory designation and function revolve around the execution of trades. Another incorrect approach that emphasizes proprietary trading as the sole function misrepresents the business model of most broker-dealers, which primarily serve external clients. Finally, an approach that suggests a broker-dealer's main role is to underwrite all new securities issues is also incorrect, as underwriting is a specific service offered by some, but not all, broker-dealers, and it is distinct from the general facilitation of secondary market transactions. Professionals should approach such questions by first recalling the core definitions and functions of entities within the securities industry, as presented in regulatory materials relevant to the SIE exam. They should then evaluate each option against these foundational principles, looking for the most comprehensive and accurate representation of the entity's role, prioritizing regulatory compliance and ethical conduct. Question 14. Benchmark analysis indicates that a client's portfolio has received a 10% stock dividend on a particular holding. The client contacts their financial advisor seeking clarification on what this means for their investment. Which of the following explanations best aligns with regulatory expectations for clarity and accuracy regarding stock dividends? Option A. Advise the client that the stock dividend is merely a cosmetic change, increasing the number of shares but having no real impact on the investment's value or future tax considerations, and therefore doesn't require further attention. Option B. Inform the client that they have received a bonus of new shares, increasing their overall wealth, and that the price per share will likely increase as the market reacts positively to this growth indicator. Option C. Explain that the client now owns more shares, and while the price per share will adjust downwards, the total market value of their investment remains the same immediately after the dividend, and the cost basis per share will be reduced for tax purposes. Option D. Emphasize that the client's investment has grown significantly due to the issuance of new shares, and they should consider selling some of the newly acquired shares to realize their profits. The correct answer is C. Explain that the client now owns more shares, and while the price per share will adjust downwards, the total market value of their investment remains the same immediately after the dividend, and the cost basis per share will be reduced for tax purposes. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a financial advisor to accurately explain the implications of a stock dividend to a client who may have limited financial literacy. The advisor must not only understand the mechanics of a stock dividend, but also its impact on the client's overall investment value and tax implications, all while adhering to regulatory disclosure requirements. Misrepresenting or oversimplifying these concepts can lead to client dissatisfaction, regulatory scrutiny, and potential financial harm to the client. Correct approach analysis. The correct approach involves clearly explaining that a stock dividend, unlike a cash dividend, does not distribute corporate assets to shareholders. Instead, it increases the number of shares outstanding while proportionally decreasing the price per share, resulting in no immediate change to the total market value of the client's holdings. The advisor must also highlight that the cost basis per share will be adjusted downwards, which is a crucial detail for future tax calculations upon sale. This approach aligns with FINRA Rule 2111, suitability, and the SEC's focus on clear and accurate client communication, ensuring the client understands the economic reality of the transaction and its tax consequences. Incorrect approach is analysis, an approach that suggests the client has received additional free money or that the value of their investment has increased solely due to the stock dividend is incorrect. This misrepresents the nature of a stock dividend, which is essentially a reclassification of equity rather than a distribution of profits. This can lead the client to believe they have gained wealth when their total investment value remains unchanged, potentially influencing future investment decisions based on false premises. This violates the duty of fair dealing and accurate representation. An approach that focuses solely on the increased number of shares without explaining the corresponding decrease in share price is also incorrect. While technically true that the number of shares increases, omitting the price adjustment creates an incomplete and misleading picture. This can lead the client to believe their ownership stake has significantly expanded in value, which is not the case. This failure to provide a complete and balanced explanation is a breach of regulatory expectations for clear and transparent communication. An approach that dismisses the stock dividend as insignificant and not worth discussing is incorrect. Even though a stock dividend may not immediately change the total value, it has implications for the cost basis per share and can affect future tax liabilities. Ignoring these aspects fails to provide comprehensive advice and can lead to unexpected tax consequences for the client. This demonstrates a lack of diligence and a failure to act in the client's best interest. Professional reasoning. Professionals should approach such situations by prioritizing client understanding and regulatory compliance. The decision-making process should involve 1. Accurately recalling the mechanics and implications of the specific corporate action, stock dividend. 2. Considering the client's financial knowledge and tailoring the explanation accordingly. 3. Ensuring all explanations are truthful, not misleading, and fully disclose relevant information, including tax implications. 4. Adhering to suitability and fair dealing standards by providing complete and balanced information. Question 15. Upon reviewing the foundational concepts of the securities industry, which of the following best encapsulates its primary function and operational characteristics within the United States regulatory framework? Option A. A regulated marketplace where issuers can raise capital by selling securities to investors, and investors can buy and sell these securities, facilitated by various financial intermediaries. Option B. A system primarily focused on short-term trading and speculation, where individuals aim to profit from rapid price fluctuations of financial assets. Option C. A centralized exchange solely dedicated to the trading of government bonds and other sovereign debt instruments. Option D. An exclusive domain for institutional investors to trade complex financial derivatives with minimal oversight. The correct answer is A. A regulated marketplace where issuers can raise capital by selling securities to investors, and investors can buy and sell these securities, facilitated by various financial intermediaries. Explanation. This scenario is professionally challenging because it requires an individual to understand and apply the fundamental principles of the securities industry in a way that aligns with regulatory expectations, specifically concerning the overview of the industry. The core of the challenge lies in distinguishing between accurate, comprehensive descriptions of the securities industry and those that are incomplete, misleading, or misrepresent its purpose and function. Careful judgment is required to ensure that any description provided is both factually correct and adheres to the spirit of regulatory oversight designed to protect investors and maintain market integrity. The correct approach accurately describes the securities industry as a marketplace where financial instruments like stocks and bonds are bought and sold, facilitating capital formation for businesses and investment opportunities for individuals. This approach correctly highlights the role of intermediaries and the regulatory framework that governs these activities. This aligns with the Securities Industry Essentials Examination's objective to provide a foundational understanding of the industry, emphasizing its role in the economy and the mechanisms by which it operates under regulatory supervision. An incorrect approach that focuses solely on the speculative nature of trading, without mentioning the underlying economic functions of capital raising or investment, misses a crucial aspect of the industry's purpose. Its failure to provide a balanced overview can lead to a misunderstanding of the industry's legitimate economic role and the protections in place for investors. Another incorrect approach that omits any mention of regulatory oversight or the role of intermediaries would be incomplete. The securities industry is heavily regulated to ensure fairness, transparency, and investor protection. Ignoring this fundamental aspect misrepresents the operational reality and the safeguards present. A third incorrect approach that defines the securities industry only as a mechanism for government debt issuance would be too narrow. While government securities are a part of the industry encompasses a much broader range of financial instruments and participants, including corporate equities and bonds, and a diverse set of investors and issuers. Professionals should approach such situations by first identifying the core components of the securities industry, its function in capital markets, the types of instruments traded, the participants involved, and the regulatory environment. They should then evaluate any description against these core components, ensuring it is comprehensive, accurate, and reflects the industry's multifaceted nature and its regulated status. This systematic evaluation ensures that their understanding and any communication about the industry are aligned with regulatory expectations and professional standards. Question 16. System analysis indicates that a government announces a significant increase in infrastructure spending coupled with a reduction in corporate tax rates. Which of the following best describes the potential impact on the economy and financial markets, considering the principles tested in the Securities Industry Essentials examination? Option A. A reduction in corporate tax rates will unequivocally lead to a sustained bull market across all equity sectors due to increased corporate profitability. Option B. Increased government spending and tax cuts could stimulate economic activity, potentially leading to higher inflation and interest rates, which might make fixed-income investments more attractive relative to equities. Option C. Fiscal policy changes have minimal impact on financial markets, as market movements are driven solely by investor sentiment. Option D. Increased government spending will primarily benefit the bond market by increasing the supply of government debt, leading to lower interest rates. The correct answer is B. Increased government spending and tax cuts could stimulate economic activity, potentially leading to higher inflation and interest rates, which might make fixed-income investments more attractive relative to equities. Explanation. This scenario is professionally challenging because it requires an understanding of how government fiscal policy, specifically changes in spending and taxation, can impact the broader economy and investment markets. Professionals must be able to discern the likely effects of these policies to provide sound advice and make informed investment decisions, all while adhering to the regulatory framework of the Securities Industry Essentials examination. The challenge lies in moving beyond a superficial understanding to a nuanced appreciation of cause and effect within the economic system, as governed by U.S. securities regulations. The correct approach involves recognizing that increased government spending, without a corresponding increase in taxation or a decrease in other spending, typically leads to a budget deficit. This deficit is often financed through borrowing, which can increase the demand for credit, potentially driving up interest rates. Higher interest rates can make borrowing more expensive for businesses and consumers, potentially slowing economic growth and making fixed-income investments more attractive relative to equities. Conversely, tax cuts can stimulate economic activity by increasing disposable income for consumers and potentially boosting corporate investment, but they can also lead to larger budget deficits if not offset by spending reductions. The regulatory framework for the SIE exam emphasizes understanding these fundamental economic principles as they relate to investment markets. An incorrect approach would be to assume that increased government spending automatically leads to a universally positive market reaction, without considering the financing mechanisms and potential consequences like inflation or rising interest rates. Another incorrect approach is to solely focus on tax cuts as a guaranteed driver of market growth, ignoring the potential for increased national debt or the specific sectors that might benefit or be harmed. A third incorrect approach is to disregard the interplay between spending and taxation, treating them as isolated policy levers rather than interconnected components of fiscal policy that influence aggregate demand, inflation, and interest rates. These approaches fail to demonstrate a comprehensive understanding of fiscal policy's multifaceted impact on the economy and markets, which is a core requirement for SIE exam candidates. Professionals should approach such situations by first identifying the specific fiscal policy actions being taken, e.g., increased infrastructure spending, corporate tax cuts. Then, they should analyze the potential direct and indirect effects on aggregate demand, inflation, interest rates, and consumer/business confidence. Finally, they must consider how these economic shifts might translate into market movements, evaluating the implications for different asset classes and investment strategies, all within the context of the regulatory principles tested by the SIE exam. Question 17. Risk assessment procedures indicate that a client is considering an investment in a publicly traded company. The client has expressed interest in potential dividend income and capital appreciation. As a financial professional, you are aware that this company has a history of shareholder activism and has recently announced plans for a significant expansion that may require future capital raises. The client has a moderate risk tolerance. Which of the following actions best upholds your professional and regulatory obligations regarding the characteristics of this investment? Option A. Advise the client that their voting rights are likely insignificant given their anticipated shareholding size, and focus the discussion primarily on the potential dividend yield and expected capital appreciation. Option B. Fully explain the implications of the company's voting rights, including how shareholders can influence corporate governance, and detail the nature and potential impact of preemptive rights in light of the company's expansion plans and potential future capital raises. Option C. Emphasize the potential for dividend income and capital appreciation, and only briefly mention that shareholders have voting rights without elaborating on their practical significance or the company's history of activism. Option D. Highlight the potential for capital appreciation and downplay the importance of both dividend income and preemptive rights, suggesting that these are less critical factors for a moderate risk investor. Correct answer is A. Advise the client that their voting rights are likely insignificant given their anticipated shareholding size, and focus the discussion primarily on the potential dividend yield and expected capital appreciation. Explanation. This scenario presents a professional challenge because it requires a financial professional to balance their fiduciary duty to a client with the potential for personal gain, all within the strict confines of securities regulations. The core of the dilemma lies in understanding and acting upon the implications of different types of shareholder rights, specifically voting rights and preemptive rights, when advising a client on an investment. The professional must ensure that their advice is solely in the client's best interest and not influenced by any personal benefit derived from the client's investment decisions. The correct approach involves prioritizing the client's understanding of their rights as a shareholder, and ensuring that any investment recommendation fully considers how these rights might impact the client's investment objectives and risk tolerance. Specifically, advising the client on the implications of voting rights means explaining how they can influence corporate governance and strategic decisions. Similarly, explaining preemptive rights is crucial, as it informs the client about their ability to maintain their proportional ownership in the company if new shares are issued, thereby protecting against dilution. The regulatory framework for the securities industry essentials examination emphasizes suitability and acting in the client's best interest. Therefore, a professional must provide comprehensive information about all relevant characteristics of a security, including voting and preemptive rights, so the client can make an informed decision. This aligns with the ethical obligation to avoid conflicts of interest and to act with diligence and care. An incorrect approach would be to downplay or omit information about voting rights because the client has a small number of shares, implying their vote is insignificant. This fails to acknowledge that even a small vote contributes to the collective power of shareholders, and that the client may have specific governance concerns. Ethically, this is a failure to provide complete information. Another incorrect approach would be to fail to explain preemptive rights, especially if the client is investing in a company that has a history of issuing new shares or operates in an industry where dilutive financing is common. This omission could lead to unexpected dilution of the client's ownership stake and a reduction in the value of their investment, violating the duty of care. A third incorrect approach would be to focus solely on potential dividend income without adequately explaining the implications of voting and preemptive rights, as this presents an incomplete picture of the investment's characteristics and potential risks. This selective disclosure is misleading and not in the client's best interest. The professional decision-making process should involve a thorough review of the client's investment objectives, risk tolerance, and financial situation. When considering an investment, the professional must then analyze all the characteristics of the security, including voting rights, dividends, and preemptive rights, and explain their significance to the client in clear, understandable terms. The focus must always be on how these characteristics align with or potentially conflict with the client's goals. If there is any potential for personal benefit that could influence the recommendation, this must be disclosed to the client, and the recommendation must still be demonstrably in the client's best interest. Question 18. Examination of the data shows that a client is seeking to diversify their portfolio with investments that offer a predictable stream of income and a degree of capital preservation, while also being open to moderate risk. Considering the characteristics of corporate bonds, which of the following best aligns with the client's stated objectives and the fundamental nature of these securities? Option A. Corporate bonds represent a debt obligation of a corporation, offering fixed periodic interest payments, coupons, and the return of the principal amount at maturity. Their value is influenced by factors such as the issuer's creditworthiness and prevailing interest rates, introducing both credit risk and interest rate risk. Option B. Corporate bonds are primarily a vehicle for aggressive capital appreciation, similar to growth stocks, and are generally considered to have minimal risk due to their fixed income nature. Option C. Corporate bonds are equity instruments that provide ownership in a corporation and are characterized by unlimited potential for capital gains and dividends, with no inherent maturity date. Option D. Corporate bonds are short-term, highly liquid instruments that are unaffected by changes in market interest rates or the financial health of the issuing company. The correct answer is A. Corporate bonds represent a debt obligation of a corporation, offering fixed periodic interest payments, coupons, and the return of the principal amount at maturity. Their value is influenced by factors such as the issuer's creditworthiness and prevailing interest rates, introducing both credit risk and interest rate risk. Explanation. This scenario is professionally challenging because it requires a financial professional to navigate the complexities of corporate bond investments while adhering strictly to the regulatory framework of the Securities Industry Essentials Examination, SI. The SIE exam focuses on foundational knowledge of the securities industry, including the characteristics and risks associated with various investment products like corporate bonds. Professionals must understand how to assess these instruments and present them to clients in a manner that is compliant with regulations, emphasizing suitability and risk disclosure. The core challenge lies in distinguishing between sound investment principles and regulatory compliance, ensuring that client interests are always paramount. The correct approach involves accurately identifying the key features of corporate bonds, including their fixed income nature, credit risk, interest rate risk, and the implications of their maturity. It requires understanding that corporate bonds represent debt obligations of a company, and that their value can fluctuate based on the issuer's financial health and prevailing market interest rates. A professional must be able to articulate these characteristics clearly, without oversimplifying or misrepresenting the risks involved, aligning with the SIE's emphasis on investor protection and fair dealing. This approach ensures that potential investors receive a comprehensive and accurate understanding of what they are investing in, enabling informed decision-making. An incorrect approach would be to present corporate bonds solely as a safe, fixed-income alternative to stocks, downplaying or omitting the inherent credit and interest rate risks. This failure to disclose material risks is a direct violation of regulatory principles that mandate full and fair disclosure. Another incorrect approach would be to focus exclusively on the potential for capital appreciation, without adequately explaining the fixed income characteristics and the impact of market fluctuations on bond prices. This misrepresentation can lead investors to have unrealistic expectations and make investment decisions based on incomplete information, which is a breach of ethical conduct and regulatory requirements. Furthermore, an approach that fails to consider the investor's individual financial situation and investment objectives when recommending corporate bonds would also be incorrect, as it neglects the fundamental principle of suitability, a cornerstone of securities regulation. Professional decision-making in such situations requires a systematic process. First, thoroughly understanding the product corporate bonds in this case, and its associated risks and benefits. Second, understanding the client's financial profile, investment objectives, and risk tolerance. Third, matching the product to the client's profile, ensuring suitability. Finally, providing clear, accurate, and complete disclosure of all material information, including risks, costs, and potential returns, in a manner that the client can understand. This process is guided by regulatory mandates and ethical obligations to act in the client's best interest. Question 19. Assessment of a financial firm that is registered as a broker-dealer and also offers ongoing, personalized investment management services to clients for an annual fee. The firm's representatives provide recommendations on asset allocation and security selection as part of this service. Which of the following best describes the regulatory framework governing the firm's provision of these investment management services? Option A. The firm must be registered as an investment advisor and adhere to the fiduciary duty requirements under the Investment Advisors Act of 1940 when providing these ongoing management services. Option B. The firm is exempt from registration as an investment advisor if it primarily earns commissions on the sale of securities. Option C. The firm's activities as a transfer agent would dictate the regulatory requirements for providing investment management services. Option D. The firm can provide these services solely under its broker-dealer registration, as long as it discloses that it is acting as an agent in executing transactions. The correct answer is A. The firm must be registered as an investment advisor and adhere to the fiduciary duty requirements under the Investment Advisors Act of 1940 when providing these ongoing management services. Explanation. This scenario presents a professional challenge because it requires distinguishing between the distinct roles and responsibilities of various financial industry participants, specifically broker-dealers and investment advisors, within the context of a client's investment strategy. Misunderstanding these roles can lead to regulatory violations, client dissatisfaction, and potential legal repercussions. Careful judgment is required to ensure that advice and services are provided within the scope of each entity's registration and fiduciary duties. The correct approach involves recognizing that a broker-dealer acts as an agent for a commission, executing trades on behalf of clients, while an investment advisor provides ongoing advice for a fee and has a fiduciary duty to act in the client's best interest. When a firm is registered as both, it must clearly delineate when it is acting in each capacity and disclose any conflicts of interest. Providing investment advice without proper registration as an investment advisor, or failing to disclose the capacity in which the firm is acting, is a regulatory failure. An incorrect approach would be to assume that a firm registered solely as a broker-dealer can provide ongoing, personalized investment advice for a fee without also registering as an investment advisor. This would violate the Investment Advisors Act of 1940, which mandates registration for those providing investment advice for compensation. Another incorrect approach would be to fail to disclose to the client the specific capacity in which the firm is acting for each service provided, e.g., as a broker executing a trade versus an advisor providing ongoing portfolio management. This lack of transparency can lead to confusion and breaches of fiduciary duty. Furthermore, a firm acting as a transfer agent is responsible for maintaining records of stock ownership and facilitating the transfer of securities, a function entirely separate from providing investment advice or executing trades, and therefore irrelevant to the core issue of advisory services. Professionals should employ a decision-making framework that prioritizes understanding the client's needs, identifying the specific services required, and then determining the appropriate regulatory registration and disclosure obligations for the firm. This involves a thorough review of the firm's registrations and a clear communication strategy with the client about the services being provided and the associated fees and duties. When in doubt, seeking guidance from compliance departments or legal counsel is essential. Question 20. Which approach would be most appropriate for an investor seeking to preserve principal, maintain high liquidity, and minimize exposure to interest rate fluctuations when considering U.S. Treasury bills, notes, and bonds? Option A. Invest in a diversified portfolio of all three Treasury security types regardless of specific investor needs. Option B. Select Treasury notes as they provide a balance between yield and maturity. Option C. Select Treasury bonds because they generally offer higher yields. Option D. Select Treasury bills due to their short maturities and minimal interest rate sensitivity. The correct answer is D. Select Treasury bills due to their short maturities and minimal interest rate sensitivity. Explanation: this scenario presents a professional challenge because it requires an understanding of how different investment objectives and risk tolerances align with the characteristics of U.S. Treasury securities. Investors must consider not only the stated features of Treasury bills, notes, and bonds, but also their inherent risks and how these align with their financial goals and regulatory obligations. Careful judgment is required to select the most appropriate security type, ensuring compliance with investment mandates and prudent risk management. The correct approach involves selecting Treasury bills because they are short-term debt instruments with maturities of 1 year or less. This characteristic makes them highly liquid and minimizes interest rate risk, as their prices are less sensitive to fluctuations in market interest rates compared to longer-term securities. For an investor with a need for immediate liquidity and a low tolerance for principal fluctuation, Treasury bills are the most suitable choice, aligning with the principle of investing in a manner consistent with the client's stated objectives and risk profile, as mandated by general principles of prudent investment management within the U.S. regulatory framework. An incorrect approach would be to select Treasury bonds. Treasury bonds are long-term debt instruments with maturities of 20 years or more. While they typically offer higher yields than shorter-term securities, they are significantly more sensitive to interest rate changes. If market interest rates rise, the market value of existing Treasury bonds will fall substantially. This exposes an investor with a low risk tolerance and a need for liquidity to significant principal risk, violating the duty to invest prudently and in accordance with client objectives. Another incorrect approach would be to select Treasury notes. Treasury notes have maturities ranging from 2 to 10 years. While they offer a balance between yield and interest rate risk compared to bills and bonds, they still carry more interest rate risk than Treasury bills. For an investor prioritizing immediate liquidity and minimal principal fluctuation, the longer maturities of Treasury notes, even at the shorter end of their range, introduce a level of risk that is not aligned with the stated objectives. This demonstrates a failure to adequately match the investment vehicle to the investor's specific needs and risk appetite. Finally, an incorrect approach would be to select a mix of all three security types without a clear rationale tied to the investor's specific needs. While diversification can be a sound strategy, indiscriminately investing across different maturities without considering the investor's liquidity requirements and risk tolerance is not a prudent approach. It fails to address the core challenge of matching the investment to the investor's unique circumstances and may lead to an unintended exposure to risks that the investor is unwilling or unable to bear. The professional decision-making process for similar situations should begin with a thorough understanding of the investor's objectives, time horizon, liquidity needs, and risk tolerance. This understanding should then be used to evaluate the characteristics of available investment products, such as U.S. Treasury securities. The selection process must prioritize alignment between the investor's profile and the inherent risks and returns of the chosen investment. Regulatory compliance and ethical considerations, such as acting in the client's best interest and managing risk prudently, must guide every decision.